Hi, and welcome back to the Business Career College video series. Again, this is Jason Watt, and in this video, we're going to look at the defined contribution pension plan. This again is a type of registered pension plan, and as with any registered pension plan, this is an employer-sponsored plan, which means the employer has a fiduciary duty to make sure that the plan is properly funded and doesn't leave the employees who are members of the plan high and dry. Now, as we've seen previously, any contributions to an RPP are going to be tax deductible, so you'll have tax deductible contributions. And tax deferred growth. And taxable income when the money comes out. So you get tax advantages along the way, but then in the end, you end up paying tax when you take the dollars out. So what has happened is defined benefit pension plans, which are sort of the original registered pension plan, have really been difficult on employers. And the problem with the defined benefit pension plan is that it creates a lot of uncertainty for the employer. The employee, of course, has all the certainty in the world here because the employer has made a series of promises for that employee. So lots of uncertainty here for employers. And as a response to that, employers have said, well, we still want to offer our employees a pension plan, but we don't like all this uncertainty that we face. So is there a better way? Well, with the DC plan, what happens is we get rid of that uncertainty. Because all we're doing with the DC plan is we're going to have the employee contribute to the plan. So the employee contributes a dollar amount, and it might be a percentage of salary. That's very common. And then the employer matches that. There's no particular promise made here, except that the employee puts money in and the employer says, okay, we'll put in 70 cents on the dollar, or we'll put in $1 on the dollar, or we'll put in some larger amount, maybe $2 on the dollar, whatever it happens to be. So now we have the employee and the employer putting money into the plan, making contributions. Those contributions are defined then, and then hopefully that money is invested and we get some growth. And at some point when the employee is ready to retire, then we will have this lump sum amount, and we will simply use that lump sum amount to purchase an annuity. And as we've previously seen, that'll be a life annuity. If the employee is married or in a common law relationship, that'll have to be a joint and last survivor annuity under the default pension rules. Otherwise, it'll just be a life straight annuity. We'll pay them income until death. And the only question here is, how much was this lump sum? That is, what was the amount here? And you won't actually know that until you get to retirement. But once you get to retirement, you know there will be something available here on which you can retire. Now I say growth here. Of course, there's always the possibility that we can have losses. Of course, you don't want that to happen, and there's not any real benefit to that, certainly no tax advantage. But it does happen with any type of investment where there will be losses periodically. So the defined contribution plan, as we can see, there's no uncertainty for the employer here. So employers very much like this. All the uncertainty in this case rests with the employee. So we've transferred the uncertainty that we have in a defined benefit plan from the employer to the employee. So the employee does not know how much this is. This is where we get the employee's uncertainty. The employer, on the other hand, knows exactly what's happening along the way. They're just putting this money in and hopefully watching it grow, but they're not overly concerned about that. They didn't make a promise that there would be some amount of money here. The only promise they made was that as the employee puts money in, so does the employer. Okay, so fairly straightforward structure. That defined contribution or money purchase plan is fairly easy to understand. Nothing terribly complicated there. I hope that helps you to understand the defined contribution plan. Please do let me know if you have any questions. Thank you very much.